Material costs are skyrocketing. Breweries are scaling back production, car manufacturers are raising their prices. All of this stems from one policy: the 50% tariff on imported steel and aluminum, which took effect on June the 4th. Consumers aren't the ones buying steel, so why are they the first to bear the cost? When the US officially imposed a 50% import tariff on steel and aluminum on June the 4th. The cost to build a home in the US immediately surged by about $10,900 according to the National Association of Home Builders. Material costs jumped and that burden quickly shifted to consumers. It's not just homes, aluminum packaging, beer cans, car parts. All prices are rising, with 76% of beer in the US. Canned companies like Ball and Crown have been forced to form internal teams. To cope with the rising costs, car prices are also climbing, as steel and aluminum are essential materials that suddenly became much more expensive. Here's the twist: consumers don't buy steel or import aluminum, but they're the first to feel the effects through every bill, every beer can, every car. But here's the kicker: this isn't the first time. Back in 2018, when Trump first imposed tariffs on steel and aluminum from Canada, Canada retaliated with billions of dollars in counter-tariffs. Meanwhile, the UAE and Bahrain quickly ramped up aluminum exports to the US, making up 8% of US imports in 2024. And this year, history is repeating itself. Canada's backlash was swift. This policy doesn't just disrupt steel and aluminum supply chains, but severely impacts the auto industry and the manufacturing ties between the two nations. On the flip side, this could aluminum industries to recover. For years, domestic producers have been forced to compete with cheap imported steel, particularly from Canada, a neighboring country that's both a partner and a competitor. Right after Trump's June 3rd decree, companies like NEWSFLASH Aluminum and others announced plans to expand, including electric arc furnaces and green smelting plants using new technologies. If the US can maintain high domestic production capacity, this could be the first step toward rebuilding the industry, preserving jobs, advancing technology, and reducing reliance on imports. However, whether this will shift the entire production chain or only save part of it remains to be seen. Just days after the 50% tariff took effect, shares of Ford and GM dropped by 3 to 4%. The auto industry, which relies on steel and aluminum for 30 to 40% of its parts, had to reassess production costs, the most viable solution, raising retail prices. And once again, consumers will be the ones paying the difference. The beer industry, especially smaller producers, is also directly affected, with 76% of beer products being canned. The increase in packaging prices has led many breweries to warn that they may shrink operations or even shut down if costs keep rising on a broader scale. Aluminum prices surged by 190%, equivalent to $1,300 per ton. This isn't just a figure in financial reports. It impacts everyday goods like canned food, household items, and car parts, all of which are becoming more expensive. Consumers are already feeling the squeeze from the $10,900 added to the cost of building a home to higher prices on beer cans, soup packages, and cars. Everything is creeping up. Canada, which supplies 60% of the US's primary aluminum, didn't stand still. Ottawa quickly retaliated with tariffs on US exports, while the UAE and Bahrain captured 8% of aluminum imports in 2024, signaling a shift in the market. The real concern isn't just about prices, it's about positioning. If trade partners find cheaper, more stable sources, they won't come back. The US could lose not just market share, but its position in global supply chains. I won't deny that the 50% tariff might provide a short-term boost to US steel and aluminum. Investment is flowing back and plants are expanding. A positive sign. Certainly, new investments from companies like Nucor and Century Aluminum are encouraging expanding electric arc furnaces and smelting plants, is creating jobs and reducing reliance on imports. But take a closer look, and the picture isn't as simple. The US steel industry still faces some of the highest energy costs in the world, with industries like aluminum being major energy consumers. Unstable electricity prices could wipe out any cost advantage. More importantly, as domestic production costs rise, industries like automotive, food, and electronics will soon shift their orders to markets like Mexico and Vietnam, where there are no tariffs and input costs are lower. The US may keep its steel industry, but it could lose the entire manufacturing ecosystem behind it. Ontario just issued $2 billion in bonds in US dollars, but there's not a single trace of Wall Street in Canada's biggest financial deal of the year if the US is no longer invited to the game with its own currency. What's really slipping through our fingers in June 2025, Ontario? The largest residential, industrial and financial hub in Canada issued $2 billion in government bonds with a 10-year maturity. This is usually an annual move to fund infrastructure, healthcare and education. But this time something unprecedented happened. No American bank was appointed as the underwriter. Instead, Barclays from the UK, along with three major Canadian financial players, Capital Markets, CIBC and Scotiabank, took the lead in attracting global investors in the financial world. This shift in underwriters speaks volumes. It's not just a technical decision, it reflects political trust, confidence in risk management, and above all, a subtle policy message. When a province like Ontario, traditionally close to US investors, actively excludes them, it shows that trust is starting to erode. Many financial publications are calling this a strategic adjustment. Some experts describe it as a symbolic response to Washington's tariff policies, but in my view, this isn't just a one-off event. It's the first sign of a strategic retreat from US dominance in North American financial systems, with increasingly unpredictable US policies, from tariffs on allies to weaponizing the dollar. Canada is quietly recalibrating its financial footing. Capital markets are about more than just money. They're built on trust, and when trust in traditional financial partners starts to fade, capital flows will adjust quietly but irreversibly. We're witnessing a form of soft sovereignty here, where countries don't necessarily sever ties with the US dollar, but actively seek to reduce dependence on the US banking system. When Ontario makes this move, it's not just a provincial decision, it's a signal to the global market that a new era is starting, one where longtime partners must prove their value, not just rely on their historical role back in the 1980s when Canada started integrating deeply into the global financial value chain. Provinces, from Ontario to Alberta, issued bonds in USD, not just for liquidity, but because the US banking system was the safest channel for connecting global investors. Wall Street wasn't just a partner, it was the backbone of Canada's capital markets after the NAFTA agreement in 1994. Cross-border credit between the two countries skyrocketed, fueling exports of cars, minerals and North American infrastructure projects. Back then, not having US banks involved in a Canadian bond deal would be like the Yankees missing from a Major League Baseball game, almost unthinkable. Even during the 2008 financial crisis, when the US banking system was rattled, Canada maintained partnerships with US institutions to ensure stability in USD-denominated bonds. But today, after 4 decades of cooperation, Ontario has chosen a different path. This shows that even long-standing trust, built over decades, can be broken by just a few shifts in policy. The clearest motivation behind this shift is US tariffs and protectionism. When the Trump administration reinstated a 50% tariff on Canadian steel and aluminum, it didn't just hit businesses, it struck at the very foundation of financial relationships. The US banking system had served as the intermediary for Canada to raise capital for infrastructure development, some of which involved industries being tariffed. This created a paradox. Canada borrowed money from US banks, issued USD-denominated bonds to build aluminum plants, only for the products from those plants to be heavily taxed by the US. According to statistics, Canada direct investment from the US fell by 177% $8 billion in Q5, an unprecedented drop since 2009. Meanwhile, investment from the rest of the world grew by nearly $75 billion. The capital didn't disappear, it just moved elsewhere. The divergence in interest rate policies between the Fed and the Bank of Canada also made currency risk insurance costs rise, making U.S. banks less appealing to the provinces. And finally, a political factor can't be overlooked. Dependence on banks that may be influenced by U.S. policy makes Canadian policymakers feel they need to pull out early before being tied down. The divergence in interest rate policies between the Fed and the Bank of Canada also made currency risk insurance costs rise, making U.S. banks less appealing to the provinces. And finally, a political factor can't be overlooked. Dependence on banks that may be influenced by U.S. policy makes Canadian policymakers feel they need to pull out early before being tied down. This seemingly technical shift is starting to create real ripple effects across Canada's and the U.S.'s economy. By excluding U.S. banks from Canadian government bonds, they lose access to one of the world's most stable debt markets. Those commission fees are no longer appearing on their quarterly balance sheets, but the impact goes further. Canadian insurance companies, pension funds and manufacturers now need to rewrite their entire capital access mechanisms. A mid-sized solar energy company in Thunder Bay reported that project financing costs increased by more than 2% because they had to use a Luxembourg bank as an intermediary instead of Citibank as before. A manufacturing business in Calgary now faces an additional 17-day delay in processing credit contracts after switching from the US-based SWIFT system to Europe's payment systems. Meanwhile, small businesses without legal teams or international consultants are struggling to understand and adapt to the new rules. A transport company in Saskatchewan said, "We're not anti-American, but we can't wait for Washington to stop politicizing everything just to secure funding." Even for consumers, the effects are beginning to show. The fluctuations in the CAD-USD exchange rate after bond issuances are causing import prices to rise, particularly for technology, electronics components, and consumer goods, based on my analysis. If this trend continues, Canada will not just diversify its financial portfolio, it will create a parallel financial system separate from the US one. This could fragment North America, which once was a unified financial bloc when provinces like Alberta and Ontario take the lead in excluding US banks. Other provinces like British Columbia or Quebec may follow suit, and if they choose to issue bonds in euros, pounds or even UN in the future, the US dollar will gradually lose its natural position in the international debt market. Additionally, Vietnam, a rapidly developing economy in Southeast Asia, sending representatives to the MIB Expo in Montreal in late 2024 is no coincidence. Canada is using trade to open up its financial sector, establishing ties with CPTP countries like Vietnam. Singapore and Japan could open up markets for Canadian agricultural, energy and technology products. But it also distances Canada from the financial centre of New York. Historically, there was a time when the UK and France were financially divided in the 19th century, and that split lasted nearly a century. If Washington doesn't recognise this, the risk is not just losing markets, but losing strategic influence in its own backyard. Is it possible to have a world where the US dollar is still used for contract valuations, bond issuances, but Americans, banks, financial institutions, even investors are no longer sitting at the negotiating table if a province like Ontario can actively exclude the entire US banking system from debt issuance? What happens if Brazil, Saudi Arabia, or even Mexico follows suit? The issue here isn't just about bonds or a few percentage points of underwriting fees, it's about trust. Once long-time allies like Canada stop automatically choosing the US as a financial partner, it's no longer a tactical shift, it's a complete strategic overhaul. And in a world where political risks increasingly shape economies, the real question isn't who's right, who's wrong, it's Is America pushing its allies away while still holding on to the currency the entire world uses? Former governor of the Bank of England isn't the type to pop champagne early when headlines shouted historic victory. He calmly reminded us many tariffs remain, and if Washington tries the same old game with a new label, things could flip overnight. His words: old policy, new packaging. When national security becomes the catch-all reason, tariff rules blur. No clear legal definitions and no consistent standards. That means any industry from pharmaceuticals to semiconductors could be next with just a White House signature for Canada. This isn't just risk, it's a strategic lesson. You can't build economic plans on whimsy, but also prove the success of Canada's East. No more West. Yes, strategy driving crude exports to potential markets like South Korea, Japan, India, and Taiwan up by nearly 60%. Colombia's shores. After a decade of failures, Canada seemed to have lost hope of diversifying its oil and gas markets, having been far too dependent on the traditional southbound flow. Yet, the crucial turning point came with the Trans Mountain Extension TMX project itself, launched in 2019 and officially brought online on May 1, 2024. TMX boosted capacity from a modest 300,000 barrels per day to a staggering 890,000 barrels, nearly tripling output and opening doors to Asian markets that Canada had only dreamed of before. Compared to 2024, of course, achieving these results came at a hefty cost. And with no small measure of fallout, TMX stands as the most ambitious energy project in Canada's history, carrying a price tag of 21.4 billion Canadian dollars, including 12.6 billion Canadian dollars to expand and upgrade the existing pipeline, alongside a slew of legal challenges from provincial governments and environmental groups. Construction delays and ballooning costs forced the federal government to guarantee up to 10 billion Canadian dollars in loans so that TC Energy could finish the project on schedule. Nevertheless, once oil began flowing westward, Canada wasted no time forging long-term agreements with British Columbia ports and signing charters for large oil tankers bound for Asia. This backdoor advantage meant that instead of suffering heavy losses from America's 10% energy tariff, Canada could improve WCS prices through competition on the international stage. Still a few dollars below WTI, but market-kedly better. Many analysts even predict that if demand from East Asian economies continues to rise, the price gap could narrow to just $3 to $4 per barrel in the near future. Looking back from abandoned projects to the TMX breakthrough, it's clear that Ottawa was forced to switch the valve on its export strategy under a knife's edge. Trump's tariff blow unwittingly became the catalyst that left Canada with no choice but to seek new export routes. Yet the Western path, though promising, carries its own risks: higher investment and logistics costs, plus stiff competition from other oil sources such as Australia or the Middle East. Can Canada sustain its crude export growth to Asia, or will it stumble into fresh barriers? The answer will only become clear as we continue to watch the unfolding drama, where North America's energy relationship has been cleaved by a rift that may be impossible to mend, just days after Washington's tariff hammer struck. Prime Minister Mark Carney convened an emergency meeting with the 13 provincial and territorial premiers on June 2, 2025 in Saskatoon, Saskatchewan. Carney's mission was crystal clear: shatter the decade-long administrative bottleneck by designating key energy and mining projects as national interest and slashing approval timelines down to a maximum of 2 years. During the marathon session, attendees hashed out a national certification mechanism for strategic ventures, from oil pipelines to LNG facilities, aimed at eliminating the usual 7 to 10 year permitting ordeal. Historically, projects have been bogged down by federal, provincial, and Indigenous consultations that drained investor patience. Yet the shock inflicted by Washington's 25% goods tariff and 10% energy levy made this rapid overhaul unavoidable without change. Canada risked bleeding tens of billions more each year into US government coffers and American refineries across the border. Immediately after the meeting, Carney told reporters that Canada must fuel domestic growth and secure energy self-reliance to narrow its dependence on the American market, and this isn't empty rhetoric. The Financial Times reports that Ottawa is drafting special legislation to fast-track implementation of priority.